For decades, China's rapid rise seemed inseparable from its insatiable appetite for crude oil. Hundreds of millions of citizens moved from rural villages into bustling cities, and with them came factories, highways, pipelines, and an industrial base that demanded vast amounts of fuel. Oil fueled not only cars and planes but also plastics, chemicals, and even the asphalt roads they drove on. Yet something surprising has happened in the past decade. China's oil imports have begun to plateau, sometimes even declining. How did the world's largest crude importer pull off such a feat? First, the oil vulnerability. China consumes about 14–15 million barrels of oil per day, importing nearly 11 million of those. The vast majority, around 90%, arrives by sea, making China dangerously dependent on vulnerable shipping lanes like the Strait of Malacca. The US, with its dominant navy and regional bases, could theoretically strangle China's lifeline. This Malacca dilemma has been a national security concern in Beijing since the early 2000s. Second, the renewable pivot. Rather than wait for a crisis, China chose to rethink its reliance on oil. Over the past 15 years, the government has quietly, but massively, invested in renewable energy and electric vehicles, EVs. The sequence was strategic: secure raw materials. China dominates rare earth production and refining, crucial for wind turbines and batteries. Build renewable capacity. Today, China generates more wind and solar power than any other country. Scale electric vehicles, backed by $200+ billion in subsidies, tax breaks, and incentives. China has made EVs affordable for the masses. This alignment paid off. In 2015, only 331,000 EVs were sold in China. By 2024, that number soared to nearly 13 million. Today, 7 out of 10 EVs worldwide are made in China, and domestic automakers like BYD have overtaken Tesla as global leaders. Third, energy independence strategy. China isn't stopping at renewables and EVs. Its broader strategy includes strategic oil reserves, building massive stockpiles during times of low prices, buying sanctioned oil, sourcing cheap crude from Russia, Iran, and Venezuela via teapot refineries, expanding domestic drilling, investing tens of billions in extracting hard-to-reach reserves, with state giant PetroChina spending more than ExxonMobil and Chevron combined in 2023. The big picture: China still needs oil, and will for years to come, but its growth in demand is slowing. Analysts predict China's oil consumption could peak within a few years before gradually declining. This marks a profound shift. The world's most populous nation, once defined by its hunger for fossil fuels, is reorienting itself toward an energy future less vulnerable to US power and global oil shocks. If successful, this transition won't just reshape China's economy, it could redefine global energy markets and accelerate the world's pivot to renewables.